It's been 10 days, very good morning to you, 10 days since the last emergency meeting of the MPC where we saw the MPR raised to 12%. We've seen a tightening in liquidity in the market, the 90-day interbank rate rising to 19% in the last week from around 13% before this meeting. What is your reaction and your views on how the hike in the MPR rate and other tightening measures has impacted the fixed income market?
Yes, Samantha, good morning. I have to start by saying that the issue of front-loading monetary policy tools is not new in the modern system of managing the economy. Since the beginning of this year, CBN has been inching up monetary policy rates in an attempt to check inflation. But this last one, the hike was by 275 basis points. In conjunction with the other monetary policy tools. It appears that CBN has exhausted all the monetary tools within their disposal in attempting to check inflation. But we will need to look at the real sector of the economy. If actually this is actually encouraging us, especially in the financial market where we play in. For banks in particular, I think this type of increase to some extent do not appear to be a shock you witness in a financial market. Instead, we are seeing that as if it's an event risk because people are already counting their capital losses. Presently, we have over 3.4 trillion outstanding in bond issuance. And if you look at from where we are coming from to where we are now, I think to a very large extent, you should be looking at over 400 billion mark-to-market loss that primary market dealers and other people who are participating in the fixed income market should be anticipating by now.
So it's going to impact banks when we're looking at their bond holdings?
In particular, I will look at the banking sector where we actually play in. I must tell you that the increase in rates presently, you do not need to engage yourself in a lot of intellectual gymnastics to see if you can lend to federal government this time around. For a 90-day bill to be at 16%, which means when you look at it, because an effective rate of 19%, I think other deposit liabilities that banks are going to get will be competing with lending to government. So in such a situation, banks are likely to have an increased cost of capital, and this will also translate to their own lending rate. And you see that the CBN have been working in a situation of stabilizing the financial market because of where we are coming from, talking of the toxic asset the banks are carrying with the income being set up. So now, if banks are going to inch up their lending rate, it can't be less than 200 basis points. And I must tell you that if people have not been able to repay loans when they were at 22%, and you are talking about 25 or 24% this time around, I think we are actually trying to build another monster this time around.
One of the purposes of increasing that MPR and increasing interest rates is also to attract foreign investors. Has this happened? Are we seeing foreigners coming into the fixed income market attracted by these higher yields?
Yeah, the answer could be yes and it could be no. But I have to look at it from this point of view. My stake is this. If actually an investor, because I think CBN is looking at a set of taking off the investor earning positive interest rates. If an investor is taking off getting a return of 16% on a treasury bill for a one-year bill, and he looks at the setting or the structural system Nigeria is operating, yes, you can earn that stuff, but in the long run, do they have this confidence that the Naira will remain? Because if you earn such huge return and you actually lose it through exchange rate, then it may be part of what will form their investment decision in coming in bullishly to come and invest in Nigerian fixed income market. So
it's all about really where the Naira goes and the uncertainty over whether we will have a devaluation. To what extent has the hike in the MPR and those other tightening measures helped to stem the Naira's decline so far?
Yeah, you can agree with me that the CBN has been trying to manage exchange rate looking at the supply end of the market. But it appears that before this hike in interest rate by 275 basis points, you remember that the last WDAS session, the Naira actually left the upper band of the oscillatory movement in between the 150 they gave, that talking about 3% deviation, plus or minus. But you see that this time around, they've seen that the demand pressure is also impossible. So they're coming now with a lot of fine-tuning exercise to mop up any liquidity. But I must tell you that with the structure we run in Nigeria, I want to believe that we have the whole money we have in circulation within the financial sector, because that's the only way we can achieve that. But my argument remains that if actually you are fighting inflation, which also have an effect in exchange rate, there's need for us to look at the long term and not at short term. I do not believe that the short-term fixes will actually take us to where we are going to.
But of course, the CBN governor is saying for now, until they're able to change those structural problems in the fiscal side of things, that monetary policy has to step in to date. Let's just move on to the corporate bond space. The Lafarge WAPCO successfully raising 11.8 billion bond there at a fixed interest rate of 11.5%. Do we know what this bond is going to be used for?
Yeah, I think they were able to conclude this exercise Friday before the Monday 10th, when the Monetary Policy Committee raised the MPR. Yeah, that was a successful exercise in a situation where there are so many uncertainty. For them to be able to raise 11.8 billion, that's good for them on the program of 50 billion. But from what I heard from the MD of the company, I think their aim is to employ this money to service their existing loan, and also in the expansion project that are going to. At least that will actually take them to have a good market reach. But at the same time, I think that sector is a place where investors, if you invest, you can beat your chest, you can guarantee whatever investment you have there, because federal government has done everything possible to build the manufacturing, especially in the sector of building materials. Because if we are talking about achieving the anticipated housing for all, the only way is to make sure we can source our own building materials, and the cement industry is a very lucrative business to be in Nigeria. But talking about from the investment point of view, benchmarking their 3-year bond with what's existing in the sovereign bond in Nigeria, I think the borrowers talking about WAPCO has actually netted the money at a very cheap rate. But at the same time, I think the investor did not do any mistake, because they looked at their financials and found out that it's what's being done.
As you say, lucky to get in before that MPR hike, with that interest rate sitting at 11.5% and that fixed. But with yields expected to increase going forward, how's this likely to impact corporate bond issuance going forward?
That is what we are talking about. If you are issuing a bond at that level, is it possible for those bonds to be liquid in the secondary market? For now, the bond trades, but not actively in a two-way market for the existing corporate bonds. The reason is because the market is not deep, and at the same time, most times the amount on issue may not be up to the standards that could come on the two-way quote market. But at the same time, with what is going on now, if we are increasing interest rates, talking about MPR the way we are doing it presently, these shocks is what foreign investors and both domestic investors are looking, trying to lock in their funds in such a long-term debt instrument, which they may find very difficult to exit from.